Usually when we talk about the stock market or corporate earnings or just the global economy in general, there's this pervasive expectation of it being entirely digital.
Right, yeah. Like a video game.
Exactly. We've been conditioned to treat it like a game. You pull out your phone, you look at a screen, numbers flash green or red, and algorithms are trading milliseconds of data. It all just feels very ethereal.
It feels detached. And honestly, it is comforting in a way. I mean, when the economy is just math on a server somewhere, completely abstracted from our daily lives.
Yeah.
Because it doesn't feel like it has real weight, You're just watching a line graph move up or down.
But then you step into the world of freight rail.
Yeah.
And suddenly that pristine digital screen just completely shatters.
Oh, absolutely.
We're not looking at algorithms in the cloud anymore. We're looking at massive thousands of tons of steel physically dragging the entire U.S. economy across mountains and, plains and rivers.
Yeah, it's dirt, it's diesel, it's steel, and it's sweat.
It is the absolute definition of a physical economic footprint.
Right. And if you want to know what is actually happening in the world, not what software company's project is happening, but what is physically being built, consumed, and hoarded, you don't just look at a tech company's user growth.
Right.
You look at what is being put on a train.
And that is exactly what we are doing today. Welcome to our deep dive into the CSX Corp Q2 2026 earnings call.
This is a fun one.
It really is. For anyone who thinks a corporate earnings call is just a bowl of financial jargon meant for Wall Street insiders, this one is entirely different.
Yeah, it's basically a real-time report card on the entire physical U.S. economy.
Because a Class I railroad like CSX, they don't just haul one thing. They touch almost every sector of the industrial and consumer economy.
They are a phenomenal barometer. I mean, they move the chemicals that make our plastics, the steel that builds our data centers, the cars we drive, and, the consumer goods we buy at big box retailers.
Basically everything.
Exactly. When their network slows down or speeds up or shifts its cargo mix, it's giving us a direct preview of what the broader economy is going to experience 3 to 6 months from now.
So whether you are an investor trying to understand the macroeconomic signals buried in your portfolio, or maybe you're a supply chain professional trying to figure out where freight is moving and why your shipping costs are changing.
Or just an insanely curious learner who wants to know how the physical infrastructure of the modern world actually operates.
Right. Regardless of why you're here, this source material is an absolute goldmine. We're going to start by looking at the incredible scoreboard they just posted for Q2.
Yeah, the headline numbers.
Then we need to get our boots on the ground and look at the friction happening in their actual rail yards, because the numbers hide a really intense labor reality.
You really do.
After that, we're going to map out exactly what cargo is moving right now and what it tells us about global geopolitics and the AI boom. And finally, we'll look at how management is leveraging all of this into massive pricing power for the future.
I mean, the headline numbers they posted are spectacular, but the underlying mechanisms of how they achieved them reveal some fascinating, almost uncomfortable tensions in the modern railroad business model.
Let's start with that scoreboard then, because before we can understand the friction in the rail yard, we have to look at the financial results they delivered to Wall Street.
Right.
And honestly, it is a record-breaking quarter that requires a serious double take.
It really does. I mean, when you look at the raw data, you have total volume, meaning the actual physical number of carloads and containers they moved, increasing by 6% year over year.
6% is huge for physical goods.
Right. And that physical growth drove top-line revenue up 10%, hitting a brand new quarterly record for the company.
A 10% jump in revenue for an established, mature business like a 190-year-old railroad is just, it's wild.
Yeah, they aren't a software startup.
Exactly. You don't just easily scale a physical railroad by 10%. But the number that really jumped off the page for me wasn't the top line, it was the bottom line. Earnings per share, or EPS, rocketed up by 23% on the quarter.
And for anyone observing this company, that 23% EPS growth is the absolute siren going off. It shows extreme operating leverage.
Okay, let's break that down for a second, because operating leverage gets thrown around on financial TV a lot.
All the time, yeah.
What does that actually mean when we're talking about trains?
Well, operating leverage is essentially the relationship between a company's fixed costs and its variable costs. A railroad has massive fixed costs.
Like the physical track.
Exactly. You have to maintain thousands of miles of track, pay property taxes on that land, maintain the locomotive fleet, and pay the core staff, regardless of whether you run 1 train a day or 50 trains a day.
So the cost of just existing is astronomically high.
Right. They own the actual physical highway they drive on, unlike a trucking company that just, pays fuel taxes.
Yeah, that's a huge difference.
But because those fixed costs are already paid for, when you start adding more volume, like that 6% increase they saw this quarter, the cost to move that extra volume is relatively tiny.
Because you're just adding a few more rail cars to a train that's already running.
Precisely. So a huge percentage of the revenue from that extra freight drops straight to the bottom line as pure profit. That is operating leverage.
I see.
They didn't just grow, they grew highly profitably, turning a 10% revenue increase into a 23% profit increase.
Okay, but this is where I have to look at the context of the quarter. Because they didn't just run this race on a flat track on a sunny day.
No, they did not.
I was reading through CFO Kevin Boone's remarks, and it struck me that this financial performance is like a marathon runner posting a personal best time, but doing it while wearing a 50-pound weighted vest.
And the vest being the cost of diesel fuel.
Exactly. The vest in this scenario is a massive headwind from the macroeconomic environment. Boone noted that they faced 160 basis points of fuel price headwinds.
Which is brutal.
In real dollar terms, that was a $177 million increase in fuel costs, simply driven by higher diesel prices in the global market. And they have no control over the price of oil.
None at all. And let's clarify what a basis point is for a moment, because Wall Street uses this term constantly to make tiny fractions sound important.
Yes, please do.
1 basis point is simply 1/100th of 1%. So 160 basis points means 1.6%.
Right.
In the context of a railroad's operating margin, a 1.6% drag is massive. In the railroad industry, everyone obsesses over the operating ratio.
The holy grail metric.
Exactly. It's essentially how much it costs to run the railroad as a percentage of the revenue it brings in. A lower number is better.
Wait, stop right there. If they had a 1.6% drag on their margins, and their fuel bill went up at almost $200 million, you would expect their profitability to take a hit.
You would, yeah.
But they reported that their operating margins actually expanded by 240 basis points. That's a 2.4% improvement in profitability. How is that mathematically possible? You don't get hit with this surprise $177 million bill and somehow become more profitable.
I know, it sounds like financial magic, but it isn't. It is relentless, aggressive, almost ruthless cost discipline in every single non-fuel category of the business.
Okay, how so?
If we look closely at Kevin Boone's math, it paints a very clear picture of how you fight a macroeconomic headwind. Total expenses for the quarter went up by 6%, which equated to about $138 million.
Okay.
But when you strip out that volatile $177 million fuel cost, their underlying controllable non-fuel expenses actually dropped by 2%.
So they took in 6% more freight, they made a record amount of money, got punched in the mouth by the global oil market, and still grew profits by 23% because they squeezed their internal costs like a sponge.
Exactly. And we can see exactly where they found those savings. One of the clearest examples is in their intermodal operations.
Let's talk about intermodal.
Yeah, it's a crucial part of the modern supply chain. Instead of putting loose cargo into a boxcar, you pack goods into standard steel shipping containers.
Those are the big corrugated metal boxes you see stacked on ocean freighter ships.
Right, and when the ship arrives at a port, giant cranes lift those boxes directly onto the back of a semi-truck or onto a flatbed rail car. CSX reported a 12% reduction in terminal costs per lift this quarter.
A lift is literally just the physical act of a giant gantry crane in a rail yard picking up one of those metal boxes off a truck chassis and placing it onto a train, right?
Right, precisely. It is a pure measure of physical terminal efficiency. A rail yard is a massive, complex dance of machinery.
Right.
You have trucks arriving at the gates, dropping off boxes. You have massive overhead cranes spanning multiple tracks. You have switch engines constantly moving empty flat cars into position.
So when CSX says they achieved a 12% cost reduction per lift,
it means they are absorbing significantly more boxes, handling more physical volume in those yards, without adding proportionate costs in terms of labor hours, maintenance, or equipment time.
Oh, wow.
They are squeezing every drop of utilization out of the millions of dollars of cranes and concrete they already own.
They are essentially turning their rail yards into highly optimized factories. So the headline is absolute financial dominance.
Yeah.
But That transitions us to the reality on the ground.
Right, the real world.
Because incredible financial numbers in a boardroom are one thing. But how were they actually achieved out in the dirt, the grease and the gravel of the rail yard?
Exactly.
You don't just cut non-fuel expenses by 2% while simultaneously increasing the amount of heavy lifting you do by 6% without creating intense friction in the physical network.
You absolutely do not. And this is where the narrative shifts from a purely financial celebration to a deeply nuanced operational tightrope walk.
Yeah.
There is an inherent physical tension between efficiency, cost cutting, and actual service delivery. If you push the network too hard, things break.
Let's start with the good news on the ground, which is safety. Because when things break on a railroad, it isn't just a delayed shipment. It can be a catastrophic event.
Absolutely.
COO Mike Query highlighted some safety statistics that, frankly, for a heavy industrial company, are phenomenal. Their Federal Railroad Administration, or FRA, injury rate improved by 19% compared to last year.
And their train accident rate dropped by a massive 30%.
30%.
Yeah. In an industry where a single derailment can cost tens of millions of dollars, trigger federal investigations, and, disrupt national supply chains for weeks, a 30% reduction in accidents is a monumental operational victory.
It's massive.
It is actually the hidden foundation of those cost savings we just talked about. Derailments are incredibly expensive. When you don't derail, your non-fuel expenses naturally drop.
That makes total sense. But I was reading through the transcript, and Query mentioned the detail that creates a massive paradox here.
Oh, yeah.
He stated that this 19% improvement in the injury rate and this 30% drop in accidents happened while total people hours declined by 7%.
There it is. That is the friction point.
I have to admit, this makes no intuitive sense to me. The volume of freight moving through the network went up by 6%. The literal hours worked by human beings, the engineers, the conductors, the yardmasters, went down by 7%.
Right.
Oh, and Query also casually mentioned that the traditional summer vacation season was hitting right as this spike in freight demand occurred.
Perfect storm.
If I am looking at this objectively, isn't that a recipe for massive employee burnout? And furthermore, isn't that a recipe for a frozen network, where frustrated customers have their freight just sitting in a yard because there is literally no human being available to move it?
You have hit on the absolute core dilemma of this quarter for CSX. And management wasn't hiding from it. I mean, it shows up directly in their service metrics.
Yeah, Mike Query was very transparent about the fact that they experienced serious tightness in the network.
They track two main metrics for speed, train velocity and terminal dwell.
Okay.
Average train velocity, which is how fast the trains are moving once they are out on the open mainline track, did improve by 3%. But they saw a noticeable increase in terminal dwell.
Let's define terminal dwell, because it is the bane of every supply chain manager's existence. That is essentially how long a train car just sits idle in a rail yard waiting to be attached to a new train, right?
Exactly.
It's like having a sports car that can go 100 miles per hour on the open highway, but you're stuck sitting in line for 3 hours at the toll booth.
The toll booth analogy is perfect. The open highway is clear. That's the 3% velocity improvement. But the toll booths, the switching yards, are congested.
Right.
A rail yard is a massive sorting facility. A train arrives from Chicago with 100 cars going to 50 different destinations. The yard crews have to break that train apart, sort the cars, and build 50 new trains.
So when volume spikes and you're short on crews, the sorting process slows down.
Exactly. The cars just sit there. That is terminal dwell.
So if they knew dwell time was increasing and customers were getting frustrated, why didn't they just hire more people?
Well, that is the deliberate choice management made, and it reveals their overarching philosophy. When demand spiked higher than expected and they were short on crews due to seasonality, they faced a critical fork in the road.
Go.
Do they immediately initiate a massive reactionary hiring wave, throwing bodies at the problem to bring dwell time down quickly?
I mean, if they do that, they immediately spike those non-fuel expenses, ruin their operating margin expansion, and Wall Street punishes the stock.
Exactly. Or do they choose to preserve those hard-won productivity gains, accept a temporary hit to terminal dwell and customer satisfaction, and figure out how to do more with the people they already have?
So they chose the latter.
They did. Management explicitly prioritized productivity. They managed this network tightness by relying heavily on technology and intense asset utilization.
And the numbers back up that choice, at least from a financial perspective. Let's look at the specific productivity metrics they use to bridge that gap between fewer workers and more freight.
Yeah, they mentioned they improved fuel efficiency for the 4th straight quarter.
which is huge.
A big part of that was maximizing the utilization of something called trip optimizer.
Trip optimizer. It's a fascinating piece of technology.
It really is. You can think of it as highly advanced, predictive, adaptive cruise control for a massive freight train.
How does that actually work? Because driving a freight train isn't like driving a car. It takes miles just to stop.
Exactly. The physics are entirely different. When you have a train that is 2 miles long and weighs 15,000 tons, the terrain matters immensely.
Yeah, I bet.
If a human engineer accelerates too hard up a hill, they burn massive amounts of excess diesel. If they brake improperly coming down a hill, they lose momentum. They will just have to buy back with fuel later.
So Trip Optimizer solves that.
Right. It's a software system that ingests the topographical map of the track, the exact weight and distribution of the train, and the track conditions. It calculates the mathematically optimal speed and throttle position for every single foot of the journey to minimize fuel burn while maintaining schedule.
Wow.
By forcing higher compliance and usage of this software across their network, CSX saved millions in diesel.
But the metric that really stands out, the one that perfectly encapsulates this do more with less philosophy, is gross ton miles per horsepower. CSX increased this for the 6th consecutive quarter.
It is the ultimate efficiency flex in railroading.
Okay, we need to break that down for the listener in plain language because gross ton miles per horsepower sounds like engineering soup.
It really does.
What does that actually look like in the physical world of a rail yard?
Well, let's visualize it. A gross ton mile is simply the movement of 1 ton of freight over a distance of 1 mile. It is the fundamental unit of work for a railroad. Horsepower obviously comes from the massive diesel-electric locomotives pulling the train. When CSX says they are increasing GTMs per horsepower, it means they are demanding more literal heavy lifting out of every single engine in their fleet.
But how do you do that without just breaking the engines?
By meticulously redesigning how you build the train. You build longer, heavier trains.
I see.
If you historically ran 2 trains a day between Atlanta and Jacksonville, each pulled by 3 locomotives, you are using 6 locomotives total.
Right.
To increase GTMs per horsepower, you combine those 2 trains into one massive super train, but you only use 4 locomotives to pull it instead of 6.
Wow.
You are maximizing the physical tractive effort, the raw pulling capacity of the engines you have online, and you are parking the extra engines to save on maintenance and capital costs.
They also noted that they increased the average tonnage per merchandise train by 5%.
Which perfectly aligns with this strategy. They are packing more freight onto every single departure.
Okay, so they run longer trains, which means there are fewer total trains running on the network. Fewer trains mean you require fewer engineers and conductors to drive them.
Exactly.
It's an incredibly efficient cascading effect. But to my earlier point about frustrated customers, Mike Query did acknowledge that service metrics aren't where they want them to be.
Yeah, they were honest about that.
The terminal dwell time is a real issue for shippers who need their goods on time. So what is the solution moving forward? They can't just keep stretching the rubber band forever. Eventually, you can't make the train any longer.
Management did acknowledge this reality. The solution they proposed is a modest increase in train and engine or T&E headcount in the coming months.
Okay.
They realize they need to inject a little bit of human capacity back into the network to support the service product and ease that tightness in the switching yards.
However, I noticed Kevin Boone, the CFO, was very quick to jump in and point out exactly how they're going to pay for these new hires without ruining those precious profit margins. They are heavily relying on a strategy called insourcing.
Insourcing is a fascinating labor strategy. It is the exact opposite of outsourcing. They are taking work they previously paid outside third-party contractors to do and bringing it in-house to use their own unionized employees.
But wait, how does that actually save money?
Yeah.
If you are a railroad, you have highly compensated union labor with pensions, railroad retirement board benefits, strict work rules.
Yeah, it's expensive labor.
Wouldn't a third-party contractor be cheaper? That's usually why companies outsource in the first place.
That is the traditional logic, yes. But you have to look at the margin structure. A third-party contractor isn't doing the work at cost. They are charging CSX for the labor, plus a 15 or 20% profit margin on top.
Right, they have to make money too.
Exactly. What CSX realized through this intense cost review is that they have existing employees, mechanics, track maintenance crews, who might have pockets of unutilized time during their shifts.
Okay.
Or by slightly reorganizing the workflow, they can absorb that contractor's duties without having to pay the contractor's profit margin.
I see. If a mechanic is already on the clock and you can organize the yard so they can handle the preventative maintenance that you used to pay a contractor to do, the marginal cost of that labor to CSX is practically zero.
Precisely. They are looking outward first, identifying all of those external contractor expenses, and finding opportunities to utilize their existing workforce more efficiently.
That's brilliant.
They are capturing the contractor's profit margin and using those savings to fund the modest T&E hiring they need to get dwell times back down, all while keeping total non-fuel expenses flat or down. It is a highly complex labor maneuver.
So they are squeezing the sponge on the yard to handle this volume. But that begs the question, what exactly is inside all those extra boxes they are suddenly lifting?
Right, the cargo.
We know how they moved it, but now we need to look at what they moved, because when you crack those boxes open, you see the entire global economy shifting in real time.
The cargo mix of a Class I railroad is the physical manifestation of macroeconomic data. It doesn't lie. And the standout segment this quarter, without a doubt, was intermodal.
The numbers here are staggering. Volume was up 9%, revenue was up 26%, and revenue per unit, or RPU, was up 16%.
Those are massive, explosive jumps for a mature logistics network.
What is driving so much freight back into those shipping containers and onto the rails?
The primary driver is the shifting tide in what the industry calls the trucking wars. For the listener who might not follow freight logistics, rail and trucking are constantly in a pitched battle for domestic freight.
Right.
For the last couple of years, the trucking market has been incredibly soft.
Soft meaning there were too many trucks and not enough freight.
Exactly. During the pandemic boom, anyone with a commercial driver's license bought a truck because rates were sky high. When the boom ended, we were left with massive overcapacity.
So rates crash.
Trucking rates hit rock bottom. And because trucks offer door-to-door service without the terminal dwell we just talked about, when truck rates are dirt cheap, freight naturally bleeds off the railroads and onto the highways.
It's just simple economics for a shipper. If a truck is the same price as a train, you take the truck because it's faster and more flexible.
Right. But Mary Claire Kenny, the chief commercial officer at CSX, highlighted that the trucking market is finally tightening. The excess capacity is being flushed out of the system.
And a big reason for that tightening isn't just organic economic cycles, it's regulatory enforcement, right?
Yes. Kenny specifically pointed out the role of the Federal Motor Carrier Safety Administration, or FMCSA.
The FMCSA.
They govern safety and hours of service for truckers. Recently, the FMCSA has been cracking down aggressively on safety violations and pulling thousands of non-compliant individual carriers and owner-operators out of the market.
So the government is forcibly removing truck supply from the highway.
Yes.
When truck supply suddenly shrinks, the remaining trucks can charge more. Truck rates go up. And when truck rates go up, a shipper looks at their budget and realizes the value proposition of rail suddenly looks highly attractive again.
It is the exact tipping point where intermodal rail regains its massive cost advantage. But it's important to note that CSX didn't just sit back and passively wait for the government to tighten the trucking market.
No, they've been preparing for this.
They have been doing the heavy physical engineering work for years to prepare for this exact moment. Kenny explicitly mentioned two massive infrastructure and partnership payoffs that are actively driving week-over-week domestic intermodal growth for them right now.
Let's talk about the first one, because it is a marvel of infrastructure engineering, the Howard Street Tunnel expansion in Baltimore.
Oh, the Howard Street Tunnel has historically been one of the biggest bottlenecks on the entire East Coast rail network.
Right.
It was built over a century ago, and it simply wasn't tall enough to accommodate double-stacked container trains.
Which means if you are moving freight from the port of Baltimore up to Philadelphia or New York, you could only put one shipping container on a rail car instead of stacking two on top of each other.
Exactly. It effectively cuts your train's capacity in half, ruining the economics of intermodal rail in that corridor.
So what did they do?
CSX, along with state and federal funding, went in and physically lowered the floor and notched the ceiling of this historic tunnel to clear it for double stacks.
Wow.
By unlocking that bottleneck, they instantly doubled their capacity and totally changed the economic math for shippers moving freight through the mid-Atlantic.
That is the power of physical infrastructure.
It really is.
The second big catalyst Kenny mentioned was their SMX partnership with CPKC. That's Canadian Pacific Kansas City. another major railroad.
Yes. The SMX service creates a seamless single-line rail connection stretching deep into Mexico, up through Texas, and across the U.S. Southeast into the CSX network.
That's a huge reach.
As companies continue to engage in nearshoring, moving their manufacturing from China to Mexico to avoid supply chain disruptions, this SMX partnership positions CSX to capture a massive wave of cross-border industrial freight.
That brings up a fascinating point about how global events reshape domestic train routes. Because when you look at the rest of their merchandise mix, the bulk goods, the raw materials, it is like looking at a massive triage unit in a hospital.
That's a good way to put it.
You've got to figure out what needs to move the fastest, except in this case, the patients are geopolitical panic buyers on one side and AI data center developers on the other. It is a wild, complex mix.
It really is.
Let's break down some of Mary Claire Kenny's insights, starting with chemicals.
Chemical volumes increased by 8%. And the context here is absolutely vital for understanding how a conflict halfway across the world instantly ripples into domestic trucking and rail capacity.
Right.
Kenny objectively noted that the geopolitical tension and the specific conflict involving Iran acted as a direct driver for what she called plastics pull forward.
And we want to be completely clear and impartial here for the listener. We are not taking a stance on the geopolitical conflict itself. We are simply examining the mechanics of how global conflict alters domestic shipping behavior. When there is widespread fear of a supply chain disruption in the Middle East, which is a massive global hub for oil and chemical precursors, what happens to a manufacturer sitting in Ohio?
They panic. It is a classic supply chain bullwhip effect. The manufacturer looks at the geopolitical instability and they realize if the Strait of Hormuz gets blocked or if a major refinery goes offline, they won't have the raw plastic resins they need to make their products.
So they stockpile.
So they immediately order excess inventory. They take orders they were planning to place in October and they pull those shipments forward on the calendar to July, scrambling to get those raw materials safely stateside and sitting in their own warehouses before any potential global supply shock hits.
So a war in the Middle East artificially spikes rail volumes in the American Midwest in the short term, as everyone hoards plastic.
Exactly. Kenny was very transparent about this dynamic. She noted that because this was a pull-forward event, they fully expect this plastics volume to moderate or drop in the second half of the year because those customer inventories are now completely full.
Because they pulled tomorrow's freight into today.
Right.
Okay, so that is the geopolitical panic piece of the puzzle. Now let's look at the metals and equipment segment, because this was an absolute standout on the earnings call.
Oh yeah, huge numbers there.
Revenue in this segment was up 14% on just a 3% volume increase.
Right.
That means they aren't moving that much more physical stuff, but they are charging a lot more money for what they are moving. What exactly is inside those train cars that is so valuable?
Steel and heavy electrical infrastructure. This massive revenue growth is being driven by three overlapping macroeconomic trends.
Okay, what's first?
First, power grid infrastructure investment. As the U.S. upgrades its aging electrical grid, it requires immense amounts of heavy materials. Second, and most intensely, is the boom in AI data center buildouts.
Everyone talks about AI as software, but building an AI data center is an incredibly heavy physical undertaking, isn't it?
It is industrial scale construction. These data centers require immense amounts of structural steel to support the weight of the server racks. They require specialized, massive HVAC and liquid cooling equipment.
Right.
And most importantly, they require heavy power components. We are talking about electrical transformers that can weigh hundreds of thousands of pounds.
Which brings us back to the rail network. You can't just put a 200,000-pound transformer on a standard highway truck.
No, it would destroy the road and it wouldn't clear the overpasses.
Exactly. To move that kind of infrastructure, you need specialized, heavy-duty rail cars. Sometimes you even need multi-axle Schnabel cars specifically designed for transformers.
The railroads have a virtual monopoly on moving the physical footprint of the AI revolution.
Yeah.
And the third driver in that 14% revenue jump was a favorable cargo mix from higher military equipment moves.
Wow, so again, we see geopolitical realities translating directly into physical freight rolling down U.S. rail lines.
It is endlessly fascinating how interconnected it all is.
But it wasn't all booming. In every earnings call, there is usually a warning sign flashing somewhere in the economy, and for CSX right now, it is in the auto sector.
Yeah, that was the weak spot.
Kenny noted that automotive shipments are noticeably softening. North American light vehicle production is expected to be down just under 2% for the year.
This is the normalization of the auto market. The post-pandemic frenzy of consumers buying cars at any price, sight unseen, is definitively over.
Because the interest rates are high, affordability is stretched.
Exactly. Inventories on dealer lots have finally normalized, and the automakers are going through their typical extended summer factory shutdowns ahead of new model launches to manage their supply.
So CSX is directly feeling that slowdown in finished vehicle shipments from the assembly plants to the distribution hubs.
Right.
And finally, before we leave the cargo mix, we have to talk about coal. Because every single year, financial pundits declare that coal is entirely dead, and every single year, it manages to surprise us with its resilience.
It just keeps hanging on.
Coal revenue actually grew 9% this quarter, and export tonnage increased by a staggering 12%. How is that possible in 2026?
Well, the resilience of coal on the rail network is largely due to the divergence between domestic policy and global demand.
Okay.
Domestically, the transition to renewables is happening, but there is still strong baseload power demand. CSX noted that recent life extensions for several major domestic power plants will support utility coal burn for longer than some of the more aggressive environmental models previously predicted.
But the real story is the export market.
Yes. The 12% jump in export tonnage was driven by specific mine restarts and incredibly strong tonnage moving through CSX's Curtis Bay terminal in Baltimore, heading out to the global market.
Wow.
While the U.S. might be burning less coal, developing nations are still deeply reliant on it for steelmaking and power generation, and CSX owns the premier logistical pathway to get Appalachian coal onto the ocean.
Okay, so we have looked at the record Q2 financial numbers. We have looked at the intense push for labor efficiency and the resulting friction in the rail yard. And we have toured the physical economy, from AI data centers to geopolitical plastics.
Yeah, it's a lot to take in.
That brings us to our final lens, management guidance and the pricing power play. We know what happened in the past 3 months. Now, what is management telling Wall Street about the future?
They are projecting deep, almost aggressive confidence. Based on the strength of the first half of the year and their structural cost cuts, they actually upgraded their 2026 full-year guidance.
Really? Upgraded it?
Yeah. They now expect full-year revenue growth in the mid to high single digits, and they expect operating margin expansion of greater than 350 basis points for the full year.
Wait, let me check the math on that. They hit 240 basis points of margin expansion in Q2, but they're projecting greater than 350 for the whole year.
Yes.
That implies they expect their profitability to accelerate even further in the back half of the year.
They believe the cost synergies from insourcing and technology are compounding, and that margin expansion drives their most staggering projection of all free cash flow growth of greater than 80% year over year.
80%.
All while keeping their capital expenditures, their spending on new track, tunnel expansions, and locomotive maintenance strictly disciplined at under $2.4 billion.
Let's ground that term free cash flow for the listener. Free cash flow is the actual literal cash left in the bank account after the company has paid all of its operating expenses and all of its capital expenditures to maintain the physical railroad.
Right.
An 80% jump in free cash flow isn't an accounting trick. It means CSX is building a massive liquid war chest. Why does that matter so much?
Because it gives them immense strategic power. When a railroad generates that much excess cash, they can aggressively buy back their own stock, driving up the share price.
They can increase their dividend payouts to shareholders.
Or they can hoard that cash to pursue aggressive mergers and acquisitions, swallowing up smaller short-line railroads to expand their network footprint. It makes them an absolute juggernaut in the logistics space.
But how exactly are they going to achieve that compounding profitability in the back half of the year? During the Q&A portion of the earnings call, I noticed something incredible.
The pricing questions.
It felt like the Wall Street analysts only wanted to talk about one single topic. I counted. And CEO Steve Angel even joked that Mary Claire Kenny had to field roughly 18 different questions back to back just about pricing.
Analysts are sharks, and they smell blood in the water. They see the tightening truck market. They see the FMCSA regulations choking off truck supply, and they want to know exactly how much blood CSX is going to extract from their customers in the form of higher rates.
And Kenny was incredibly graceful under pressure.
She was. She navigated all 18 of those questions without giving away specific forward-looking percentage numbers, which would ruin their negotiating leverage. But the underlying message to Wall Street was unmistakable. They are fiercely focused on what they call value of service pricing.
Okay, I am putting on my shipper hat here because this is where the friction we talked about earlier collides with the financials.
Yeah, let's hear it.
If I am a manufacturer shipping goods on CSX, and I am currently dealing with the increased terminal dwell times we discussed, meaning my freight is taking longer to get through the yard, my supply chain is stressed, and the service isn't perfect, how on earth can CSX justify aggressively raising my prices right now?
It's a great question.
Won't I just flee back to a trucking company the second highway capacity loosens up again?
It is a totally valid challenge, and it is the exact tension the analysts were probing. The answer lies in the intense segmentation of the freight market and the nuance of what they call same-store sales pricing.
Okay.
Let's unpack the difference between domestic intermodal pricing and international intermodal pricing, because it is crucial to understanding why CSX has so much power here.
Let's do it.
Domestic intermodal spot pricing is indeed accelerating rapidly right now. This is freight booked on short notice, often literally days in advance.
Okay.
This market is heavily and immediately influenced by the tightening of the truck market. Because truck capacity is suddenly scarce, shippers are desperate to find a box to put their goods in. CSX can and is raising prices on the spot market quickly to capture that desperation margin.
But spot pricing is a very small portion of their overall business, right?
Yeah.
Kenny mentioned they don't want to be overly exposed to the daily swings of the spot market.
Exactly. The vast bulk of their intermodal business is either contracted domestic or international. Let's look at international intermodal.
Okay.
This involves moving those containers directly off the massive ocean freighter ships at the ports of New York or Savannah and moving them inland to Chicago or Dallas. This market is highly concentrated among just a few massive global steamship lines.
Right.
These movements are heavily contracted under multi-year long-term deals. This revenue is fundamentally insulated from the daily volatility of the domestic trucking market.
So they have a massive, incredibly stable base of contracted revenue that just hums along in the background.
Yes.
And for the merchandise segment, the chemicals, the metals, the heavy forest products CEO Steve Angel said they approach pricing surgically. He talked about looking closely at the customer's next best alternative.
That is the core of value of service pricing.
Right. If a customer is shipping a 100-ton electrical transformer for an AI data center, what is their next best alternative? It isn't a truck. A truck physically cannot do the job.
Exactly.
The next best alternative is practically nothing. You have to use the rail network. So CSX knows they have incredible localized monopoly pricing power on those specific types of heavy industrial moves, and they are not afraid to use it.
Exactly. Angel made a profound statement during the call. He said, "I believe that industries that become too focused on market share eventually drive out profitability."
That's a strong statement.
It is. What he means is CSX does not want volume just for the sake of volume. They don't want to move a box if they are barely breaking even on it just to claim they have a bigger market share than their competitors.
Right. They want profitable freight.
They only want freight that actively increases operating income and delivers strong returns on the immense capital they have invested in the track. That is a highly disciplined, ruthlessly profitable approach to running a mature network.
So as we bring all these disparate threads together from the digital screen down to the ballast in the steel, what is the ultimate takeaway for the listener from this deep dive into CSX's Q2?
We have to synthesize the dual narrative of this company right now. On one hand, from a purely financial and boardroom perspective, this quarter was an absolute masterclass in cost discipline and margin expansion.
Absolutely.
They navigated brutal fuel headwinds, absorbed a 6% increase in physical volume, and dropped a massive, disproportionate amount of cash directly to the bottom line through sheer operational leverage.
But on the other hand, down in the rail yards, they are walking a very delicate, almost dangerous tightrope regarding network fluidity and labor capacity.
Yes.
They are squeezing the sponge so incredibly hard that terminal dwell times are creeping up, the system is groaning, and they're relying heavily on their existing workforce to do significantly more with less through insourcing and technology.
Exactly. And if you zoom out to a macroeconomic perspective, if you are a listener simply watching the broader U.S. economy, the specific transition of freight from truck back to rail,
which we discussed with the FMCSA regulations.
Right. Coupled with the massive amounts of heavy infrastructure and data center materials moving across the country, signals that underlying industrial activity in the U.S. remains highly robust.
It paints a picture of an economy that is aggressively building the physical structures of the future, the upgraded power grids, the massive AI data centers, the nearshored manufacturing facilities.
All while simultaneously dealing with the immediate, gritty constraints of labor shortages and logistical bottlenecks.
Which naturally brings us to the ultimate question regarding the future of this industry.
Yeah, the big question.
Yes, I want to leave you with a final provocative thought to mull over. Something that builds on everything we've explored today about how this railroad actually operates.
Go for it.
CSX is currently achieving these record revenues and this staggering 23% EPS growth, largely by squeezing every possible drop of physical efficiency out of their existing 190-year-old asset base.
Right, they're pushing it to the limit.
They're running longer, heavier trains. They're operating with reduced human headcount. They are insourcing labor to cut contractor profit margins. They are maximizing gross ton miles per horsepower to the absolute limit.
Yeah.
But what happens when you hit the absolute ceiling of physical efficiency?
It is a collision with the laws of physics. Eventually, you literally cannot make a train any longer without breaking the steel couplings that hold the cars together or exceeding the physical length of the passing sidings on the track.
Exactly. You cannot increase the weight without crushing the rail bed. You cannot cut a single additional worker from a yard without fundamentally compromising safety and regulatory compliance.
So when you reach that absolute physical limit, when the sponge is entirely dry, where does the next wave of monumental financial growth come from?
How does a CEO justify the next quarter's EPS growth to Wall Street? Is it reliant entirely on aggressive, relentless pricing power over a captive customer base?
Or is it the introduction of total AI automation and autonomous locomotives in the rail yards? Are we waiting on entirely new, undiscovered rail technologies? Or is an inevitable plateau coming for these massive legacy networks?
It is a structural question that every investor, supply chain expert, and economic observer needs to be asking about the North American rail industry right now. They have optimized the past, now they have to invent the future.
Beautifully said.
You know, we started this deep dive talking about how the world of freight rail shatters the illusion of a purely digital, ethereal economy. It grounds us in the heavy, unyielding reality of thousands of tons of steel and physics.
It really does.
But maybe, just maybe, overcoming that looming future ceiling of physical efficiency will require the railroad to embrace the digital world and become a little more like an algorithm after all. Thanks for joining us on this deep dive. We'll see you next time.